Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. The federal government has moved faster than they have in the past to provide support for both Main Street and Wall Street during the COVID-19 pandemic. And this support has been crucial at the time, but it does come at a cost. Joining me to discuss how that will impact the municipal bond market is Stephanie Larosiliere. She's a senior CPM of the municipal sector with Invesco. Stephanie, it's great to have you back. Welcome to Trade Talks.
Thank you. Thanks, Jill.
All right, Stephanie, before we get into the cost to municipal bonds, how was the muni space impacted as a result of COVID-19?
So, the municipal bond space, historically, because we are so heavily dominated by retail investors, we tend to have, sell-offs and other, market downturns be very exacerbated. So that was not, that was definitely the case this time around. And so what we had was tremendous amount of outflows. We had people selling municipal bond assets, selling municipal bond mutual funds in droves. And we had, billions of dollars leave municipal mutual funds. And so, what we have seen is the investment grade side of the market took a pretty big hit. The high yield side of the market took an even bigger hit. But since then, we've actually seen investment grade municipal bonds actually come back quite a bit. We're now very close to pre-pandemic levels. So that has tightened up quite a bit. But when it comes to high yield, that is where the market is still believing there is some speculation, and we have not seen the high yield municipal market come back in the way the investment grade space has.
How will that cost impact the municipal bond market? Because we have to pay the piper at some point for all of the stimulus that's been injected into the system.
Exactly. And, that is our viewpoint, is that at some point in time, this is going to have to be paid for. And the way that programs like what we have seen typically do get paid for are through higher taxes. So when we think about taxes going up in the United States at the state as well as the federal level, where there goes, increased demand for municipal bonds because people are trying to avoid, paying those higher taxes by earning, well, not avoid, I would say offset by earning, tax exempt income. So for us, we actually believe that there's no real way to get around this. Taxes are going to go up.
That's pretty tough for some of the states that have seen so many of their tax benefits as it relates to their mortgages, having been removed over the past few years. That's going to be a tough one, especially for those of us in the Northeast. So where do the opportunities exist in the muni space right now?
So we do think the short end of the curve is actually a good spot to be in, especially if you can be in a mutual fund vehicle. Right now we're looking at, yields of just about 2% in our short-term muni product. And that's much better than you can get in a money market fund at this point, and much better, honestly, than you can get in a high quality individual bond. So we actually think, the short-term part of the market is definitely presents some pretty good opportunity. But in addition to that, as I mentioned, the high yield space, high yield still has not seen the spread tightening. We're still seeing, high yield spreads above their long-term average. And we do believe that when it comes to high yield municipal bonds, that's where doing that due diligence and that research to understand the idiosyncratic risks that are presented in individual credits is going to be key. Because, on a go forward basis, we definitely think that you want to stay away from those managers that are more beta players. We want to be with managers that are going to find alpha, are going to avoid the credits that we believe will have, significant issues as we continue to make our way through this pandemic.
So Stephanie, if you don't understand the municipal bond market as well and its nuances, why do you think the high yield market has not seen that recovery like other different classes of the muni space have?
Sure. So it's, essentially a case of the baby out with the bathwater. So people have been looking at sectors where, the high yield muni market invests pretty heavily. One of those is the healthcare sector. So we all know, with hospitals having really strictly focused their attention and their resources to fighting COVID-19, they have had to do without many of the high cost surgeries and other procedures that typically fund a lot of these hospitals. So, the hospital sector has taken a bit of a hit. Also for us, continuing care retirement communities are a sector that we've liked over the years. When we think about the changing demographics in the United States, 10,000 people a day will turn 65 over the next 20 years. And so we believe these facilities are really important to the growing, older demographic. But what happened with these facilities is we've seen the headlines, nursing homes. Nursing homes were the epitome of the COVID-19 outbreak, and where the epicenter of really where that occurred. And so CCRCs, which are completely different from nursing homes, actually got hit pretty hard because people equated them as being very similar to nursing homes. A nursing home is a facility where typically people don't have a choice. They go into a nursing home because their health has declined and they now need that additional care. When it comes to continuing care retirement communities, these are, the next stage of people's lives where they actually make that choice to, now live in this amazing community, which provides a tremendous amount of support for individuals living there. So it's a totally different, schematic in terms of how those facilities are run. And when it comes to CCRCs, we have seen that take a hit because they, are equated as being very similar to nursing homes.
Appreciate the background. Thanks so much, Stephanie, for joining us on Trade Talks. And thanks.
Thank you.
You're welcome. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.